Now, the way that I did it in the book is to define relative changes in the addressable market as beta and relative changes in market share as alpha. Beta is just the standard percent change formula, delta AM over AM1. This is the same as AM2 over AM1 minus 1, or the addressable market growth equity return multiplier minus 1. Alpha is the percent change of a percentage, delta MS over MS1, and this is the same as MS2 over MS1 minus 1, or the market share growth equity return multiplier minus 1. Now, in the domain of equity return multipliers, revenue growth is the product of the addressable market growth and market share growth, and we can replace the later two fractions with 1 plus beta and 1 plus alpha. This allows us to solve for alpha, which is R2 over R1 divided by 1 plus beta, then minus 1. And that's how we would typically do it. We pull the addressable market change from an industry report or economic data, and then use beta, R1, and R2 to calculate alpha. Now, this makes our logarithmic model very simple. We just swap out the multipliers with 1 plus beta and 1 plus alpha, and we're done. Unfortunately, the derivative model is a little more complicated. In the book, I show that the addressable market part of revenue growth is equal to beta over 2 times the quantity R1 plus R2 over 1 plus beta. The market share part of revenue growth is equal to alpha over 2 times the quantity R1 plus R2 over 1 plus alpha. These two terms always add up to delta R, and when you plug them into the revenue growth formula, you get two new value drivers, one for addressable market growth and one for market share growth.